The concept of leveraging, or using debt to create wealth, is rooted in the idea that borrowed capital can be employed to generate returns that exceed the cost of the debt. This financial strategy is often referred to as the leverage principle. While leveraging can amplify returns, it also comes with increased risk, and individuals or businesses need to carefully consider their financial position and risk tolerance before using debt to build wealth. Welcome back to another exciting video from Blueprint to Wealth. Today's video is about debt to wealth, the leverage principle. Before we start the video, please like, subscribe, and press the bell icon. Borrowing to invest. Individuals or businesses may borrow money to invest in assets such as real estate, stocks, or business expansion. The goal is to generate returns on the invested capital that are higher than the interest paid on the borrowed funds. Real estate leverage. Real estate is a common area where leverage is employed. Buyers often use mortgages to finance property purchases. If the value of the property appreciates, the return on the initial investment can be much higher than if the property were purchased outright with cash. Financial leverage in businesses. Businesses often use debt to finance operations, expansion, or acquisitions. This can magnify profits, but it also increases the financial risk. If the returns generated by the invested capital are lower than the cost of the debt, it can lead to financial distress. Risk considerations. Leverage magnifies both gains and losses. While it can enhance returns in a favorable market, it can also amplify losses in a downturn. Individuals and businesses need to assess their risk tolerance and ability to service debt in various market conditions. Interest rate risk. The cost of borrowing is a critical factor. Changes in interest rates can impact the affordability of debt and affect the overall returns on leveraged investments. Tax considerations. In some cases, interest payments on debt may be tax deductible, providing a potential tax advantage for leveraging. Diversification. Diversification is crucial when using leverage. Concentrating leverage in a single investment or asset class increases the risk of significant losses. Monitoring and adjusting. Regular monitoring of the leveraged portfolio and adjustments to the strategy may be necessary to adapt to changing market conditions. Benefits of the leverage principle. Magnified returns. The primary allure of leveraging is the potential to magnify returns on invested capital. By using borrowed funds, investors can control a larger asset base and benefit from the appreciation or income generated by that larger base. Accelerated wealth accumulation. Leverage can expedite the process of wealth accumulation. For instance, in real estate, a relatively small down payment can allow an investor to control a property worth much more than their initial investment. Access to larger investments. Leverage enables individuals or businesses to participate in larger investment opportunities that might be beyond their immediate financial capacity. This can be particularly advantageous in competitive markets. Tax efficiency. In some jurisdictions, interest payments on certain types of debt may be tax deductible. This tax advantage can enhance the overall efficiency of a leveraged investment strategy. Risks and challenges. Interest rate risk. Changes in interest rates can significantly impact the cost of borrowing. Rising interest rates can increase the expense of debt, potentially eroding returns and increasing financial strain. Market volatility. Leveraged investments are more susceptible to market volatility. In downturns, losses can be magnified, and investors may be required to meet margin calls or face forced liquidation of assets. Liquidity risk. Leveraged positions may face challenges in accessing liquidity, especially during market downturns. Forced asset sales to meet debt obligations can result in losses. Debt service obligations. The ability to service debt is crucial. If cash flow or returns from investments fall short, meeting debt obligations can become challenging, leading to financial stress. Asset value fluctuations. The value of leveraged assets can fluctuate, and if the market value falls below the outstanding debt, individuals or businesses may experience negative equity. Concentration risk. Concentrating leverage in a specific asset class or investment can expose investors to heightened risk. Diversification is essential to mitigate this risk. Considerations for effective leverage: risk tolerance and financial position. Understanding one's risk tolerance and financial position is paramount. Leveraging should align with an individual's or business's ability to withstand market fluctuations and unforeseen challenges. Diversification. Diversifying across different asset classes or investments helps spread risk. Avoiding overconcentration in a single investment minimizes the impact of poor performance in one area. Monitoring and adaptation. Regularly monitoring the performance of leveraged investments and being prepared to adapt the strategy in response to changing market conditions is essential. Stress testing. Conducting stress tests on the portfolio can help assess its resilience to adverse scenarios. Understanding how the portfolio would perform in different market conditions is crucial for risk management. Professional advice. Seeking the guidance of financial professionals, such as financial advisors or investment experts, is recommended. They can provide personalized advice based on an individual's or business's specific circumstances. In conclusion, while the leverage principle can be a powerful tool for wealth creation, it should be approached with caution and a thorough understanding of the associated risks. Balancing the potential for increased returns with the need to manage risk is crucial for long-term success when employing leverage as a wealth-building strategy. Don't forget to like this video, subscribe to our channel for more informative content, and hit the notification bell to stay updated. If you have any questions or suggestions, please leave them in the comments section below. Thank you for watching, and we'll see you in the next video.